2020, the year where this unknown prick called the coronavirus popped the bubble, maybe, that we're currently in. One thing is for sure, this short-term, sharp shock to the economy that the coronavirus brought onto us will act as a catalyst which will usher in long-term change. There's a lot of opinions right now as to which way it will all go and what it will look like in the new world. But one thing is for sure, we will never be the same. We will never work the same. Our economy will never function the same. This is a really, really important event that's currently unfolding. So today in my discussion with Jarrod Kerr, the chief economist at Kiwi Bank, we unpackage some of the trends that will end and some of the trends that will start, some of the businesses and sectors that will die off, and some of the businesses and sectors that will actually thrive. Hope you enjoy this episode of The Everyday Investor.
Yep.
All right, Jarrod, thank you very much for joining me on the NZ Everyday Investor podcast today. Really appreciate your time.
Good to be back.
Yeah, good to be back in the saddle. Bit weird not being there in the flesh, but to be honest, this is starting to get kind of normal now, isn't it?
Yeah, I've done so many of these in the last 2 weeks. It is becoming normal, and it's quite handy when you think about it. We're not traveling as much.
No, it is. It's really noticeable, like how I operate in my business. Traditionally, it's been, I'm on the phone and I'm making meetings and I have to wait to do business until I get in front of them. And now it's like, right, we're going for it. And with the added advantage of actually being able to share screens, take notes and save recordings of this, it's actually quite a handy technology to use. I'm going to have a tough time breaking up with it. I probably won't break up with it. I think I'm going to actually, significantly change my business now as a result of this, which is great.
Yeah. And hopefully not the only one.
No, and no, it's not. It's going to be awesome. So today, I really just want to take you through a series of questions that I've been chewing on a little bit as I try to understand some of the macroeconomic considerations in the short, medium, and long term. And you being the chief economist of Kiwi Bank, I thought, why not reach out to you, get you on, and just pick your brains. So let's get started, shall we?
Yeah, far away.
All right, cool. So one of the things that I read recently, must have been just in the last few days, was the NZIER, the New Zealand Institute of Economic Research. They put out a quarterly survey of business confidence, and they put something out recently which made for pretty grim reading, as you would expect. And it showed, 54% of firms expect to cut jobs, 61% of firms expecting lower activity for the year ahead. Basically, it's just no confidence out there. Do you want to just talk to me about what the significance of what those reports are and what it actually really means?
Yeah, sure. I mean, the QSBO survey is probably one of the best that we have, if not the best. It's a really quite comprehensive survey of business appetite and business confidence.
Yeah.
And going into a lockdown, businesses lost confidence and they've started to realize there's going to be a substantial drop in activity.
Yeah.
Now, it's important to note that the survey itself actually stopped on the 20th of March. So we weren't even in lockdown. This is businesses expecting a slowdown. So if you were to take that survey today, they would have had 2 weeks of being in lockdown and having their businesses shut. So their confidence, I would imagine today, is much lower than what it was 2 or 3 weeks ago. But this is what we're going through. This is what we all know, and that our economy is contracting, it's falling. Our activity obviously gets hit when you lock down an entire economy. But we're hoping that in the next few weeks, we get some clarity around how we're going to reopen our economy, what our economy is going to look like in the next 6 months to a year, so that we can start looking ahead, lifting our heads again rather than looking down and closing doors.
Correct. After the accident, after the event has occurred, how are we going to actually rebuild and shifting our focus? So these reports, and I guess to a certain extent, a lot of economic indicators that are out there, sometimes they're leading indicators. They kind of predict the future of what's about to happen, and sometimes they just tell the story of what's already been, and you kind of have to guess. Like this one, you kind of have to guess, well, we're probably not much better than that. But last year, I remember looking at some stuff, and it was the yield curve, which just tracks that, the interest rates over time and what the yields are over a period of time. And you can infer from looking at the curve of that what is coming up ahead. And at the time that that was inverted, which is normally historically a signal that tough times are ahead, there was actually no sign that out of China was going to be coming this horrible pandemic that would shut down the entire world's economy. There was no sign of that. There was all these other signals, and people were kind of speculating where's the next prick to this bubble coming from. We were just guessing, and then that kind of just went away, and we all kind of forgot about it. And then this happened. Do you think that sometimes these indicators can kind of tell the future? Like, what's your opinion on that?
They're normally pretty good actually, because you've got thousands of investors investing money in different assets and pushing prices to where they think they are based on all the information that's out there. And don't forget, we were going through the beginnings of a trade war last year between the United States and China, two largest economies putting tariffs against each other, and we were looking at what sort of disruptions that would have on global manufacturing, global supply chains. And it also pointed to the fragility of the economic expansion last year. I mean, we've been expanding for a long time. We were getting to a point where questions were being raised over how long it would continue, particularly with this rise in protectionism. And we were obviously very worried about that trade shock right up until the end of last year. And it was only the signing of that phase one deal, which we've all forgotten about, that confidence was somewhat restored in the markets. And then out of left field, so to speak, we've been hit with a pandemic.
Yeah, it's weird, isn't it?
Yeah.
So in a sense that yield curve, there was some fundamental issues that were happening at that time, and those issues have now swapped to the pandemic. But to a certain extent, we've been expanding for so long that in essence, there's almost like this fatigue that was creeping in, and like everybody just needed a break anyway, right? So there's a bit of that going on too.
Yeah, I mean the bull market in equities that everyone's been talking about has been running for so long. Valuations were looking a little stretched. There were legitimate question marks being raised early on. So that all comes into how we were feeling coming into this year. But then to be hit out of left field with something as dramatic as this, you sort of throw all that out the window and you immediately focus on the problem at hand. And that is, we've got a pandemic, we've shut our borders, and we've effectively turned our economy off.
Yeah, it's crazy. And in a previous episode or two ago, we covered the prick that was to pop the bubble that we're in. But to a certain extent, in equity markets, we haven't really seen, and I hesitate to say we haven't seen the full extent of it, because we don't know necessarily whether things will continue to fall. It seems like even at that time of recording and yesterday, in fact, things have rebounded actually quite nicely. And so it's hard to actually understand how these fundamental drivers are driving the equity markets, because it's not always that predictable. Is there something going on in terms of manipulation that's kind of distorting how things are working right now?
I think, well, there's a few questions in there. So I think the distortions, yes, I believe the funds that have been pulled out of equity market funds, for example, has exacerbated some of this. Some of the machines that have had to have been turned off in financial markets because they're not trading well. The machine's only learned on the last sort of 20, 30 years of information and can't really cope with that. So we've seen machines being pulled out of the markets. There's a lot of interesting things happening in financial markets, but at the end of the day, we're talking about firms being shut down, and the E on the PE, no one has any idea about. So what do?
Right.
The P is falling. So the price is falling because we've got no idea on what earnings is going to do. So there will be a lot of winners in this. There will be some industries that do particularly well, and we're seeing their shares outperform. And there are clear losers in this, and their shares are being hit very hard. Fixed income markets are a bit more of a pure play, and we have seen interest rates fall quite sharply on the back of this.
Yeah. Okay. So talk to me about that then. So talk to me about some of and this might be an obvious answer. I think it'll be an obvious answer in some areas like tourism, for example. But what are some of the sectors that will clearly suffer in the short, medium, long term here that we're looking at because of this pandemic?
So short, medium, and long term, I think
Yeah.
parts of the retail sector for sure. But I think that structural change was taking place anyway. There's already been a big move to online retailing. There's already been some significant changes in retail space, and the Amazon effect, is continuing, where you can actually buy something directly from the manufacturer and have it delivered directly to your house. So that's taking out businesses along the way, but that was already in process. What I think the pandemic will do, it will accelerate that change. Um, Tourism, I think, is a really interesting one because obviously it's hit hard right now with borders being shut. We don't know when our own border is going to open, let alone when other borders are going to open, and even how we're going to interact with each other. I can imagine it would be pretty easy for us in 6 months' time to say, yeah, we'll start taking Australian or UK or a couple of other countries around.
Mm,
But when do we truly open our borders up to tourism again? And will they want to come in
mm,
such a short period of time? Short term, yes, heavily, heavily hit. Medium term, definitely still down. But long term, I'm a believer that we actually haven't lost anything here in New Zealand that tourists value. Our mountains are still here, rivers, still the most beautiful country in the world. We've still got hobbits running around tending to our herds.
yeah.
They'll all still want to come back, in my opinion. I just don't know when.
Yeah.
Hopefully
Hobbits are
it's a
tending to
year, maybe it's
to
two.
the herds or the herbs.
Both.
Both. Yeah, that's right. We should be doing both right about now, I suspect. But you're right. We are we still are living in the best country in the best part of the world. Um, you know, if you've been living overseas, which you have, and so have I, you realize that, and that hasn't gone away. If nothing else, the country's getting a bit of a rest, which is great. We're flushing out all the algae, which is
Yeah,
awesome, and it's
yeah.
just going to be even better. And dare I say, when and if we can get out of this with our businesses intact in the tourism sector, we're poised probably for even greater growth, I would imagine. Would you agree with that?
Yeah, I think so. I think, New Zealand's not going to fall off people's bucket lists. People enjoy coming here. They have a great experience and we enjoy having them here. It's a big part of our culture. And it's a bit like Italy. Italy's been hit much harder than we have. Their tourism sector is much larger than ours. But I would definitely go back to Italy. It's a beautiful country. The history is incredible. What you go there for hasn't changed. And just because they've had an outbreak and it's dangerous today, I would have forgotten about that in a year's
That's
time.
right. Yeah, exactly. So, some of the sectors and this will play out, and I suspect there'll be a couple of little Easter egg surprises in terms of some areas that will emerge and become even more amazing that we haven't even imagined yet, right? Like, there's going to be some
Yeah,
things that come out of this that just blow our minds. This is the time for creativity and coming up with amazing solutions to problems that you didn't know existed. Because there's some aspect of this world that we're living in now might actually persist into the new world anyway.
yeah. And I hope it does. I really do. I hope it does. Some of the good things that are coming out of this right now is what we're doing today.
Yeah,
So rather than me, for my job, flying down to Wellington regularly and then around the regions, maybe I can do more of these chats,
yeah,
and maybe that is good enough for our clients. So therefore, that's less travel, that's less accommodation, that's a lot less cost that the bank has to wear, and maybe I can work from home more than what I am. So maybe we don't need 4 or 5 floors of a building in the middle of town with thousands of cars trying to get to it every day.
yeah,
Maybe we can actually reduce the congestion on our roads by actually encouraging people to do this and work from home. And that's maybe 1 or 2 days a week where we don't have to get that extra childcare. We don't have to do other bits and pieces. It actually becomes a little bit more
yeah.
efficient. I don't know about you, but working from home, I get to work earlier and I leave later.
Yeah. Well, that's true. And I was catching up with somebody recently about this, and they are I think James Brown. He's the 4 day a week ambassador, and he's really hot on this topic, right? And And I was just thinking to myself, well, yeah, that's absolutely true for some people. Some people will be way more productive by being forced to do this. I know for me, I'm starting to have meetings with clients from all over the country rather than just in Auckland, which is something that in my mind I was thinking, well, I'm going to actually have to hit the road now and do a lot more traveling, which wasn't ideal. But now I'm starting to realize, actually, yeah, this technology has always been here. I just haven't been forced to use it. So for a
Yeah.
lot of small to medium sized enterprises, I think, especially in the advice space or the face to face space, we're starting to come to grips with that and realizing that, yeah, there is actually this huge silver lining here that we can grow our businesses now in this way, which is cool.
I think so. I think it's very cool, and I think there's a lot more efficiencies to be made out of this.
Yeah,
And it doesn't have to be every company. There's a lot of companies where you just can't do this, right? They can continue, but it's about the ones that potentially can,
correct.
getting them involved could free up, a lot
Yeah,
of
totally.
resources.
Totally. Like, just think about your doctor, right? Your doctor's going to be able to do something like this, surely. Your plumber, not so much, but your doctor for sure, right?
Yeah.
So now tell me, so kind of following on that then, what do you see as some of the trends? Like you talked briefly before about the trend that was already in motion around the retail space and how things are shifting online. It was already doing that. Now that's going to be just rocket fuel in that space. What are some of
Mm.
the other trends that you see will start to emerge as a result of this?
I think the technology, the use of technology to get things done. I think if it was on this sort of trajectory, it will be cranked up a gear, and so it should be. As you mentioned, the classics, the doctor. Rather than going down there, maybe you can use a robot on your phone that asks you a bunch of questions, and maybe 5 times out of 10, the person's told you're okay. Well, that's 5 less people going down waiting in a waiting room. Great.
Yeah,
There's a lot of other things that I hope start coming through in technology space that allows us to do a lot more online. Banking, we've got a lot of work to do to make it completely online and not have people relying on branches as much. And that's it's a much faster interaction with clients. And I can imagine you can go right through accounting, lawyers, all the service sector,
correct.
and the more that we can do, it frees up time. And I think Xero was one of those classic examples of taking a whole lot of information, putting it onto a platform, and freeing up the time of accountants.
That's right.
And the more we do like that, the better outcome for the client at the other end.
Yeah,
An accountant
yeah,
might usually spend 20 hours on a client. 15 hours is collecting information, and there's 5 hours of advice. Now it's the other way around. And
that's
I
right.
think
Yeah,
that sort of, and people like yourself as well, the more information you can put through online, the
correct.
better service you can give your clients.
Yeah, that's right. I think of this. He was economist Joseph Schumpeter. You know that guy? Good old
No.
Joe. Good old Joe. I remember reading something about this guy. I think he was an Italian economist, and he coined the phrase "creative destruction," where whenever there's an innovation, it usually will displace the incumbents to some degree, and it will destroy as that new creation comes in. And I guess what we have right now is we have a destruction creative process happening right now, where we're being forced into change, but out of this is coming this real cool, creative new solution. So it'll be fun to watch this, eh?
Yeah,
But
yeah.
tell me, like isolationism, deglobalization. Do you see those trends starting to emerge? Like we're shutting our borders, trade's being restricted. Is there a risk that we might just get used to it and it might just continue to persist?
Yeah, look, if you look at the globalization indexes that are out there, globalization basically peaked 5 to 10 years ago, depending on the measures. So the amount of trade that we're doing in terms of total output has been plateauing for a while, and over the last 5 years, it's actually started to come off. So what we've seen is an increase in restrictions on each other basically since 2010. So that trend, if you like, I think may accelerate a bit here. a lot of our clients who were importing stuff from China or other parts of the world have all of a sudden found that their supply chains have been disrupted. And that was before the lockdown, obviously. So I think at a minimum, these sorts of businesses will be looking at their supply chain saying, do we just rely on one country, or do we diversify a little bit, maybe get something from India or the Philippines? I think that's the minimum response.
Sure.
But where I think a lot of governments and also businesses will want to try and push is to try and insource back into New Zealand a lot of what we do, rather than relying on a call center in India, which is no longer open, for example.
Right. That's interesting, isn't it? So maybe that, and indirectly, presumably that will increase some of the costs for those inputs as well, right?
Definitely.
So
Definitely.
I guess where this is going potentially is one of the drivers for inflation going forward as well, right?
Yeah. So that'll be one part. If that takes place and we decide to insource a lot more, build our own pallets and bits and pieces other than ship them in, that'll be done at a much higher cost, because New Zealand wages and materials are more expensive than getting it from the lowest cost producer on the planet in China. But that might be the risk that we're willing to take, and that might be the price that we're willing to pay. So, the cost of whatever it is that you're buying might go up 10% because we've made it in-house. But it might become the trend. I want New Zealand made. I don't want made elsewhere.
Right.
And so that'll have an inflationary impact. But what we've seen on the back of this pandemic is the exact opposite. So oil prices have come flying off a cliff, and that's both the demand for oil dropping, but also the Saudis and the Russians upping their supply at the exact same time.
Yeah, good timing.
That's one of the biggest drivers of inflation globally. So inflation over the next 6 months is going to be much lower than what it was 6 months prior, and that will linger into next year. And then if you're thinking about the demand and supply dynamics of everything that's going on at the moment, I think that it's a very disinflationary environment. So inflation is going to be very low for a while yet.
Yes. And going on from that, then, what about deflation? Is that a real concern, a real risk that we have?
I think of the risks that we have in front of us, hyperinflation, the big, inflation spiking really high, or going into deflation. I think deflation's more likely. But it's something that we desperately don't want to happen, because we know how to deal with high inflation, but we don't actually know how to come out of deflation if it's entrenched. And you look at the Japanese. So obviously central banks and governments would do whatever they can to stop that from happening.
Yeah, that's the big scary elephant in the room as far as I'm concerned. That whole the D word, really, not depression, but deflation. Probably they're linked.
And just to clear it up for your listeners too, a lot of people think, well, deflation, so what? The price of everything that I buy is going down. It's like, yeah, but the price of you, the price of your worth, your salary also goes down, and sometimes it goes down by more than the price of everything else. So you're actually worse off. That's the Japanese experience. People forget that their own value, their own wages is a price, and that can fall.
That's right. Yeah, you are your biggest asset.
Yeah.
All right. So let's just take a pause right here, and I will just get my head together. I can still edit this later on. And we'll talk about the rate cuts by the RBNZ, the challenges, and then we'll kind of pivot talking about the the role that the government is playing, the monetary and the fiscal response for following on from that. And then this is where I'll bring in that slide if I can. And if we have a tech failure, we'll just
doesn't matter. I can talk. I've got it here on mine, so I can.
Cool. Okay, we'll have a crack at it. Excuse me. So, okay. All right. So, Jarrod, I follow a lot of the reports that you guys put out, and you've always been fairly optimistic around what the Reserve Bank will do in terms of rate cuts, and you've been calling it fairly good, I think, over the past couple of years. And at the beginning of March, when the pandemic was starting to kind of unravel a little bit, and we kind of knew where we were going, and we were kind of looking for the Reserve Bank for some guidance, you you were calling for a 0.5% reduction in the official cash rate, which for our listeners, that affects a lot of things. But one of the things that affects for the everyday homeowner is the floating interest rate. And they came out with a 0.75% reduction on the official cash rate, and they did it before the time that they said they were going to do it. Did that kind of surprise you? Obviously, your expectations would have been shifting closer to the time of that announcement, but was that kind of surprising?
Yeah, it was. We saw central banks overseas reacting aggressively to the outbreak, and we saw them cutting rates. So we naturally said, right, Reserve Bank, it's time for you to step up to the plate, and it's time to cut 50 basis points. And what I liked about what the Reserve Bank did is they made an emergency decision, so out of the cycle of their normal decisions, and they dropped it straight to as low as they're willing to go. So if we were at 1.5% or 2%, I think they would have, almost put it there in one move anyway. They only had 75 to deliver, and they got it out of the way. That was the key message. And then they told us it's going to stay at 25. It's not going negative, which they had flirted with last year, but it's going to stay there for at least a year. And that gave the market certainty. Okay, bang, we can set our short-term interest rates off that, and it provides the start of the term structure for our interest rates in New Zealand. So it was a very important move. The next move that they did, I thought, was even better, and that was to come out a week or so later and say, right, we're seeing dysfunction in the government bond market, which is very important. We're going to buy $30 billion worth. Now, to put that in perspective, sounds like big numbers. It is. There's 75 billion outstanding. So they're going to buy 40% of government bonds, which is huge.
Yeah.
And the number there is the 40%. So they believe they can take down 40% of a government bond market without causing too much dysfunction. And that's based on international evidence. So our government bond market's not going to stay at 75. It's going to become 100 pretty quickly as they issue more to do their fiscal response.
Right.
So that 30 is going to become 40. And the central bank has also come out and started buying council debt. So there's another 3 billion on top, and that'll probably be topped up as well. The great thing there is that the central bank can create as much money as they like on one hand to buy a government bond with the other.
Right. And for the layman who may be aware of some of the other terms that this is known as, this is effectively is quantitative easing, isn't it?
Correct.
Right. And for New Zealand, that's a little bit unusual for us to do stuff like this. It's quite unconventional for the Reserve Bank to do this. So on one hand, they've used their conventional tool, the lever of the official cash rate. They've pulled that down to the lowest setting, and they did that swiftly. And now they've indicated to the market that is what it is. But then they pull out this bazooka that was needed, and they've proactively pulled it out way faster than what I was expecting to see. I was kind of wondering what they would do, but it's almost like they were primed, they were ready. It's like they knew what they needed to do, and they just did it. Were you surprised at the speed of it, of how it happened?
Well, again, the speed, yes, very fast, and both the RBNZ and the government has been working at an extraordinary speed compared to what they're used to. But when you look at overseas central banks, the Fed had already gone, the RBA had already gone, the Bank of Canada, a lot of other central banks had already started doing this or restarted doing this. So it was only natural for us to follow down this path. They knew they had to do it, and I'm very impressed that they got out and did it as soon as they did.
Yeah. No, it's pretty cool. It's part of me wonders what they're going to do next. Like, do you think that there are going to be other unconventional moves that they start doing, or is this the extent of what we're going to see here?
Potentially, yeah. So they've bought government bonds. They're going to buy council bonds. So they're doing LGFA at the moment. I believe they might have to.
What's LGFA? What does that mean?
Sorry, it's local government funding authority. I hope I got that right.
Yeah.
But they basically they basically get funding on behalf of councils.
Okay.
And then Auckland Council, because it's so large, it does a lot of its own funding outright. Same with Christchurch, and then there's a number of other government-owned entities out there that might need funding as well. So the central bank may have to come in What's interesting though is that other central banks around the world have actually started buying corporate bonds.
Right,
So
that's the next
corporates
level.
like
Yeah,
Fonterra, our big, healthy corporates issue debt, and if that market seizes, which it's seized at the moment, then other central banks have come in and put in a bid saying, hey, we'll buy and we'll keep that market liquid. And it's important right here, right now, that companies like Fonterra and our biggest have access to capital.
got it. Awesome. And do you see that they're going to be doing other things which will affect, say, mortgage holders in the form of, say, mortgage-backed securities? Do you see stuff like that happening?
So they're already doing that. The good thing that the central bank has done is I focused on the bond markets, but
Yeah,
they have come out and they've made sure there's loads of liquidity for the banks,
yeah, yeah.
and that's important. They've opened these term lending facilities where we can take our mortgage-backed securities, give them to the central bank for cash if we need it. We don't at the moment, but if we did, it's there. And they are very supportive of the banking system,
Yeah,
and that I think is crucial, and it's crucial for your listeners to understand that, because
yeah.
the crisis that we've just been through in 08, 09 was one where banking paper banks seized, and they didn't get the support from the central banks at the time, and it was only when these markets blew up that they looked back and gone, oh, maybe we should have stopped that from happening. So here we are this time around, and it won't happen because the
Awesome.
central
Yeah.
banks simply won't let it happen.
They learned last time. That's why they're so fast this time. And
Correct.
the primary function of the Reserve Bank is to, you might have to help me out here, but is to create financial stability in the banking system, right?
Yeah.
Did I say that right? So,
The way I like saying, they're the banker of the banks.
yeah, yeah. And they are actively doing their job. And what that means for the everyday investor is that we can have confidence that the financial system is actually being worked on very, very severely right now. And there's a lot of good people doing stuff, and it seems to be working pretty good, dare I say.
Yeah, and that's important to know, because it's important to know that our money markets are functioning, and they are, because if the government's coming out and trying to do other things and the financial markets aren't functioning, then it won't work.
Mm.
So we've got the financial markets functioning reasonably well. There's a bit more that needs to be done, but the more important piece here is actually the fiscal, not the monetary.
You were quoted as saying, that the best response to this pandemic is a fiscal response, not just a monetary response. So can you just unpackage what that means a little bit?
Yeah, so basically what the central bank can do is it can make sure that you and all your listeners have a low interest rate, which is great.
Yeah.
And that they can make sure that the banks are shored up enough that you can have access to credit. But most of your listeners right now, who businesses have shut down, couldn't care less what their interest rate is.
Yeah.
They want to know whether they're going to come out the other side. So monetary policy is very blunt, and it's very good for helping financial markets. But in a situation like this, fiscal policy is the most targeted. So the government can actually give you, Darcy, money into your back pocket directly, whereas the central bank can only work on an interest rate if you have one.
That's right.
Um, so the difference is it's very, very targeted. Now, what the government has done to date has been very good. Of the options that they had, and there weren't many, they came out with the wage subsidy straight away, and that's simply because they can do it, and because they've done it before. So that was the first thing that came out, and the important point about that is keeping employees linked to employers, so that when we come out of this, they're still on the books. There's still a job there. They've still, tied those two together. So that helps with the individual and the company. But the more important thing that they have done is the business finance guarantee scheme, where the government has taken 80% risk on any loan that's made to a business, which is big. They're using their balance sheet here,
Mm.
and they've got the central bank to provide funding to the banks for 3 years at a low cost, in order to lend out to businesses in need. We take 20% risk on these loans. We know the customers better than anyone else. We know them better than the government. We know them better than the central bank. So we look through our businesses. Let's say half of them come to us and say, we need help. And we go, right, here's a loan, here's a loan, here's a loan. And that money is designed to sort of get you through this almost like a hibernation period where we're locked down. You pop out the other side, and sure, you've got a bit more debt at a low interest rate. But given what our call centers have been putting up with, there's a lot of businesses out there that are very keen for the assistance.
Right. So the current response that we've seen is appropriate for the current phase that we're in. But when we get out of this phase and we're post-lockdown, that's where we're going to need to see other stuff, right? Like, and this is where the confidence, if I'm honest, my confidence is pretty high in the government's response right now for where we're at. But I do worry a little bit about the next phase post-lockdown. Are they going to be as good as how they've been so far when it's all about rebuilding businesses and actually rebuilding? That's the part that I'm honestly struggling with, because maybe it's my perspective, or maybe it is what it is. I just don't know if they've got that skill set, and I don't want to get political, but do you think that, tax cuts, do you think that other sorts of things will come into play a lot more when we get post-lockdown?
Potentially. We're going to have to see how we get out of it. If it's just 4 weeks and we manage to open a lot of things up again, hopefully not. If it's 3 months and it's taking another 6 months to really open back up again, then a lot of businesses are going to really struggle in that environment, and there will need to be a lot more measures to get them through if they are to survive. What I think is very good is that the government has been very open to talking to banks, talking to businesses directly. Are you hurting? Why are you hurting? How can we help? And I think that they're very open to a lot of different ideas as to how to get businesses through that. And that's the important thing, because the government really is the one with the balance sheet that can expand its spending or reduce its revenue, as you say, to get us through this. But what's difficult is that we're in a situation where you can't stimulate demand.
No.
Now, you and I suffered through the same economics courses.
Yeah.
Most stimulus packages are here to increase demand. How do you increase demand when you're stuck in your room?
That's
you
right.
give me an extra $10, I can't spend it.
That's right.
It's not really that useful, is it?
No.
So it's about maybe giving some of that stimulus when we come out and say, right, here's $10 in your back pocket. Go and spend it.
Yeah. That'll be interesting to see how it all works, right? Like, we haven't done this before, so this part's going to be new. Like, this is going to be really interesting, where, like you say, what's been lost or what's been paused potentially has been lost, and it might not be caught up, right? Like, the cafes that haven't been trading, it's not like they're going to trade a lot more when everybody's out and about. Yeah, maybe that's true with some of them, but a lot of that revenue is lost, and it's written off, it's gone, it's never coming back. And that's not a problem that you can necessarily solve just by lowering the taxes, because that assumes that there's money coming in. There's got to be something else going on. So it's going to be interesting. It's going to be interesting.
Yeah, you're absolutely right, and it's lost money, as you say. I mean, just because you haven't been to a cinema for the last 3 weeks doesn't mean you're going to rush back in there and do 3 or 4 weeks worth in one go. It's gone.
Yeah,
you're just not going to go. You're now on Netflix.
That's right. We need more Lord of the Rings trilogy somehow.
That's right.
I don't know if Jarrod. Okay, Jarrod. So as we come to an end here, I just one more question, and this is where I'll loop in some of the slides that you've given me here. How bad can it get? And I know this is a really broad question, right? And we're looking at this, and it's kind of like when you cut yourself really badly, you want to look at that wound. You want to see how disgusting and how septic that thing is, because you want to know where's the bottom of that pond, right? Like, how bad and how deep is this cave going to go?
So basically, we've realised we're in lockdown, and we've updated our forecast, right, as we all have to. Now, 4 to 6 weeks of lockdown is going to take about 12% off our GDP for the second quarter, and that follows a small fall in the first quarter. So there's your recession, and the way out of it is a little bit awkward depending on how we open up. And our central forecast shows, a bit of an awkward bounce, but we do get back to some decent growth in 2021 and into 2022. That's our central view, but that is a huge economic disruption. There is a worst case scenario out there where we could be in some sort of lockdown in some form for 3 months, or we come out of lockdown, back into lockdown, come out of lockdown, back into lockdown. And that could take as much as 30%.
Wow.
Off GDP. Now that is a very severe scenario, but the sort of scenario that we have to run through as businesses and banks to get our heads around what that actually means.
Yeah.
And we're going to see a rise in unemployment. Unfortunately, we think it's inevitable here, and we'll see unemployment lift from around 4 and a bit percent, getting up to around 8%. And that concerns us. That's a lot of Kiwis out of work, but then hopefully into 2021, 22, we start to get on top of it.
Right.
And
so it's awkward on both sides. The reduction in GDP will be like a W, so a sharp decline, a little bit of a bounce, but maybe an awkward recovery where there's another decline before there's a more sustained recovery. And then on the unemployment numbers, it's going to spike upwards and then hopefully come down, and then maybe spike upwards again before it comes down in a sustained fashion.
Yeah. It's overly. We've made it overly complicated, but basically you've shut down the economy, and the longer you shut the economy down, the worse it gets. And then even when we open up, we realise economy bounces back, but there's been less income. People just don't have the confidence that they once did. Investment plans have been postponed, and that's where you get this W start fall. Yeah. But in that worst case scenario that I talked to you about, unemployment could rise as much as 15%, which is where I think we're pretty much at in the United States already. And the difference between 4% and 8% is huge. But obviously the difference between 8% and 15, 16 is that much worse. So the longer that we are in lockdown, the worse the picture becomes. And at some point we need to make the call, well, how long do we want to keep the economy locked down?
Because, we might be killing the virus, but we're killing the economy.
Yeah.
It's a pretty blunt instrument.
And mental well-being in this, do we really need to keep people locked down at the risk of all the abuse that's happening out there and potential rise in suicides on the back of this sort of stuff? It's a good debate that needs to be had.
Yeah, and it's an awkward one as well. And it's fraught with difficulties, right? But at the end of this, when we look back at this, I don't even want to even mention it, but the suicide rate compared to the mortality rate or the loss of life because of this pandemic, you got to actually weigh it up. And obviously we're trying to spread the load so that we're protecting our health system, but at what cost? Because there's going to be a lot of collateral damage here. And we'll in hindsight, we'll be able to judge this a little bit more accurately, I think. But right now, it feels like what we're doing is appropriate. And I guess we have to remember this when we get to the other side, and we're critical on what we did because it's possibly appropriate for what we know right now.
Yeah.
Okay. So before we finish up, Jarrod, because that was a bit of a bombshell, let's be honest. Is there any glimmering signs of hope? I'm actually quite hopeful. I'm hopeful for a lot of small businesses. I'm hopeful that we'll see a lot of really awesome, creative ideas and sustainable businesses that rebound really quick. I'm hopeful that we'll see a lot more transactions and a lot more, I guess, liquidity in a sense happen in the residential property market. I think there'll be a lot more transactions coming up.
Yeah.
That's probably the extent of what I can personally see. And I think there's probably also going to be a lot more balance for everyday investors. They're probably going to look at risk a lot differently going forward. So that I see a lot of positive stuff here, but what do you see?
Yeah, I agree. I think we always underestimate our ingenuity, right? Our ability to deal with situations like this, and then the exciting stuff that comes out of it, the new technology, the new way of doing things. We might be, a greener country on the back of this. We're going to pour a whole lot more money, even more, into infrastructure and other investments on the back of this. So I think there's a lot of good things that we can do to really boost our growth and our potential going forward. And I'm with you 100%. I'm really excited to see how we change after this. I think we'll have a much more flexible workforce, more people working from home. We'll spend a lot less on unnecessary travel. We'll do a lot more communication like this. I think there's a lot of efficiencies to be made out of
Mm,
this, and maybe we improve our supply chains as well.
mm.
I think we will use this. We will see our weaknesses, and will really do our best to fix them.
Yeah, awesome. Well summed up. Well, thank you very much, Jarrod, for coming on the NZ Everyday Investor again. Really appreciate that. It's been too long in between drinks, so I'll have
Yeah,
to get you on a bit more frequently, I think, going forward. Especially talking about stuff like this. Like this is one of those current events that I hate to kind of fall into that category of being a commentator on current events because I think that it's always so temporary. But there's something quite important about what we're going through and the lessons that we're learning right now, I think can really equip us for better handling stuff in the future, which will help us make better investment decisions. So thanks for being a part of that. Really appreciate
yeah,
that.
absolutely. Thanks.
Cool, man. All right. Take care.
Cheers, buddy.
All right.